Over the past 2 years, inflation has risen to new record highs. In October, the Federal Reserve and the Labor Department released new inflation data, and the numbers were scary. Inflation rose to its highest level in over 30 years. So with inflation rising to new record highs, you would think that the stock market would be afraid and uncertain of what's coming next. However, in 2020 and in 2021, the stock market just seems to be setting its own records, new record highs. But by the end of 2021, the Federal Reserve and the federal government are starting to make some serious monetary changes, and that ultimately could mean a lot less money printing. And while that might help inflation to become stable in the United States, it also might send Wall Street reeling into a new crash. So today I want to talk about how inflation is going to affect the stock market and what the Federal Reserve is doing to cause this. I also want to discuss if inflation is going to lead to a stock market crash, or if we're going to see things continue to rise in 2022. So if you want to know exactly how inflation may affect your investments, you might want to stick around till the very end of this video. But before I break all of this down, my name is Nate from Minority Mindset News, and if you like this video, make sure to smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world. We can keep making videos just like this one. Inflation in the United States has hit new record highs recently. In October of 2021, the Labor Department put out their Consumer Price Index report. This essentially shows how prices are changing from month to month in the United States and what exactly is affecting them. And as you can probably imagine, it was not a good report. Overall, inflation increased by 6.2% in the month, and core inflation was up by 0.6%. Core inflation is a little bit different than actual inflation in the country because it excludes some things like food and energy. That is the preferred method for the Federal Reserve to look at inflation. They typically see the core inflation numbers as the best measuring point. But overall, inflation is now at its highest point since December of 1990. That's well over 30 years. And to be fair, inflation is high right now, but it has been high in the United States before. In the 70s and 80s, inflation was around 13%. That's more than double what we're experiencing now. However, right now, inflation is more than double what we're used to seeing. Inflation typically hovers around the 2 to 3% mark, as all things typically go up in price every single year. And in general, as the United States government prints more money and adds to our monetary supply, then that means inflation is naturally going to rise. Like I said, as long as the government's printing money, that means inflation is going to go up. But over the last 2 years, the United States government and the Federal Reserve has printed trillions of dollars. Most of this money has been used to lift our economy out of the recession. We had stimulus checks, we had the Paycheck Protection Program for businesses, and we had extended unemployment benefits. And with all this money floating around, that meant Americans went out and spent a bunch of money. In addition, a lot of Americans weren't working, so they had nothing but time to go out and spend money. That led to our current supply chain issues, which is even boosting inflation more. Now, the Federal Reserve has come out and said that inflation is merely transitory. This means that it's only temporary and is only being caused by our pandemic and the supply chain issues. And they've also said that inflation right now is just a little bit higher than even they were anticipating. And through this all, inflation and money printing and a labor shortage and supply chain issues and a pandemic, the stock market has gone through all of this. Seems like it's invincible to all the world's problems. Like I said at the beginning of this video, the Dow Jones, NASDAQ, and S&P 500s have all set new record highs over the last year or two. This is coming off of a time when the stock market was crashing. If you remember back in March of 2020, the stock market essentially crashed and we saw the biggest and fastest drop in stock market history. On February 14th, 2020, the Dow Jones hit a new record high of around 29,000 points. But by March of 2020, just 1 month later, the Dow Jones dropped over 10,000 points and was under 20K. And the S&P 500 and NASDAQ did the exact same thing. They dropped at their fastest rate since the the stock market crash of 1929. And what this had essentially done was wipe out 3 whole years of stock market gains. That is a big drop. But ultimately, all 3 of those major indexes recovered, and the stock market in general is now booming. The Dow, for instance, just hit a new record high and is around 36,000 points. So since its crash in March of 2020, it has now crashed, recovered, and then broken new records. So what the heck is going on here? Well, the first thing you need to understand here is the stock market is kind of weird. There are a lot of different factors that affect a stock's price and affect what the stock market will be. The whole point of the stock market is that it's a mutually beneficial exchange. We have investors who pour money into Wall Street and stocks in order to own a piece of that company. Now, what the company gets is free liquidation capital. They get thousands, millions, and sometimes billions of dollars from investors, and they can take that money and grow their company. Investors will get a partial share of ownership in this company, and then they can go on and hold this investment for a long period of time and then sell it for a massive profit later. So there is a lot of money to be made in the stock market. But there is also a lot of money to lose here, around $28 trillion to be exact. That is almost the entire amount that the United States government has in debt. The US government currently has around $29 trillion in debt. And because there are a ton of different factors that affect a stock and the stock market's value, that means that investors are afraid of losing money. This can cause a crash. And it also means that the stock market can be volatile. This means that the price of an individual asset can either skyrocket or drop within a few days. And this is essentially what led to the stock market crash of 2020. A lot of investors were very emotional and were afraid of losing money. This is because of the pandemic. They knew that there was going to be a lot of industries that were going to close down. And when industries close down, that means people are out of work and companies are no longer making money. And if companies have bad earnings reports and lower profits, that means stock prices are ultimately going to go down. Investors don't want to see this, so they started pulling their money out. They started selling their investments. If a mass quantity of investors start selling their investments, well, that can lead to a stock market crash. We've seen this time and time again on Wall Street. A lot of companies that trade on the New York Stock Exchange depend on that money constantly coming in. And on the flip side, investors depend on dividend income and the value of their stocks continuing to rise in order to retire, in order to make a profit. Because you have to remember, it's more than just hedge funds on Wall Street. There's also a lot of everyday regular people like you and I investing on Wall Street. That means the regular person is going to lose money here as well. So the stock market essentially crashed in March of 2020. That much we know, that much is history. So why has it boomed since then? Well, the stock market has boomed since March of 2020 for a variety of different reasons. The first reason is that the Federal Reserve has printed so much money, trillions and trillions of dollars, in fact, since the pandemic started. Our economy is capitalistic, and in its very simplest terms, that means our society is run on capital. It's run on money. The more people that are spending more money, the better our economy works. So if nobody is spending money and a lot of people are saving, that means that our economy is ultimately going to shrink. Nobody likes to see that happen. The Federal Reserve doesn't like to see that happen, and the president and current administration don't like to see that happen either. But if everyone has money, that means people can go out and spend this money. This means that the economy can grow because businesses are starting to grow. And if businesses are growing, then they can afford to hire even more people. So this is exactly what happened in March of 2020. The Federal Reserve and the federal government saw the stock market was crashing, that this pandemic was not going away anytime soon. They knew that millions of people were going to be out of jobs, so they decided to turn that money printer on and print trillions of dollars in stimulus and in unemployment assistance. In addition, they added the Paycheck Protection Program so that businesses would be more incentivized to keep employees instead of firing people. So essentially, businesses were going to make a lot less money because people had less money to spend. So the federal government decided to step in and give businesses money so that way that could help supplement some of their costs and give them back some of that money that they lost. So this helped ease Wall Street a little bit because they knew that a lot of people were still going to get money even though they weren't working. Wall Street doesn't really care if people are working, they care if people have money to spend. And the federal government wants to incentivize you to spend more money. So they gave people stimulus checks with pretty much no strings attached. And then the Federal Reserve also decided that it was going to lower its benchmark interest rates to near zero. Since interest rates were a lot lower, Wall Street loves this too, because this incentivizes more people to go out and borrow money. Now people could get a loan, they could get a mortgage for way less than they could before because interest rates were much lower. Now more money is being created. So we now have more money in circulation, which means more money to spend. And more people getting more mortgages means that mortgage-backed securities on Wall Street are also going to rise. But that's a full breakdown that we'll discuss on another video. But that's not all. The Federal Reserve took one step further and decided it needed to buy billions of dollars every single month in bonds and treasury notes on Wall Street. This is called quantitative easing, and the Federal Reserve has been participating in this for a while now. Pretty much since the pandemic has started, the Federal Reserve has been buying $120 billion every single month of bonds on Wall Street. And since March of 2020, the Federal Reserve has bought around $8 trillion in treasury notes and bonds. The stock market loves this too, because you're essentially giving companies billions and billions of dollars every single month for doing absolutely nothing. That continued to push up the stock market. So all three of those things have now driven the stock market to new record highs. However, some things are about to change. The Federal Reserve has announced that it's pulling back a lot of its stimulus programs. As of September of 2021, stimulus checks and unemployment benefits, at least extended unemployment benefits, are gone. In addition, quantitative easing is starting to get pulled back too. The Federal Reserve announced that it would drop its bond buying by around $15 billion a month through July of 2022. That means it's beginning to taper off its bond buying until it completely exits the market. And you're probably wondering, well, why now? Why is the Federal Reserve deciding that right now is a good time to pull back all of its monetary programs? Well, the key and number one reason is inflation. One of the key roles of the Federal Reserve is to monitor inflation and to create monetary policies that hopefully combat inflation if it gets out of hand. The Federal Reserve and the federal government are willing to do what it takes right now in order to stop inflation from getting any worse. Now, this doesn't really help the United States as a whole in general because inflation typically affects the average person the most. Investors invest their money because they want to protect themselves against inflation. If inflation is around the 2 to 3% mark every single year, and that means your money is losing 2 to 3% in value every single year. The more money that is printed, the more all of the current dollars are devalued. That simply means that you cannot buy the same things that you could with the same amount of dollars. Even though the products and services haven't really changed, inflation is making things more expensive. So investors put their money on Wall Street and into other investments to protect themselves from inflation. They get a sometimes 7 to 10% return on their money. That means their money is growing by 7 to 10% and not losing 2 to 3% of its value every single year. Unfortunately though, the majority of Americans don't really know about inflation and they don't really know how it affects them, and a lot of Americans still save their money. If you put your money into a savings account year after year, it's going to lose value. This is because the average interest rate on a savings account is 0.01%. That means for every $100, you might make 1 penny. And that's if you're lucky. Most savings accounts offer even half of that. So your money is not really doing you any good in a savings account. Investors know this, but the average American doesn't, so that's why they call inflation the secret tax on Americans. Everybody ends up paying for it, but some Americans end up paying more for it because they are financially uneducated. And the fact of the matter is, inflation is always going to exist because the Federal Reserve needs inflation to survive. The United States government has around $29 trillion in debt. So if the value of our money kept going up every single year, that debt would be way too expensive to pay off. The United States government would essentially default. But because our money goes down in value every single year, because the Federal Reserve continues to print more, that means that all of the United States debt gets smaller. Not technically, but because the value of money goes down, that means they can pay off this debt with cheaper dollars. So the Federal Reserve and the federal government need inflation to survive, but it's their job to keep it stable so that way the entire economy doesn't collapse. But nothing lasts forever, and the Federal Reserve is now deciding to pull back a lot of its money printing and start upping its monetary policies. The fact of the matter is, the stock market is not going to like that. A lot of experts in the stock market believe that when the Federal Reserve starts tapering off some of its bond buying and asset purchasing, well, we're going to see a taper tantrum from some investors. This happened back in 2008 during the Great Recession when the Federal Reserve was essentially doing the same thing. In order to push up markets to give a lot of these companies some extra capital, the Federal Reserve started pouring money into Wall Street. And when they started to pull that back, a lot of investors and companies got upset. They had it great and easy for so long, but now things are starting to come down again. Markets didn't essentially crash, but they did start dipping. And the same thing might happen in 2022. Once investors know that these billions of dollars that the Federal Reserve is pumping into the stock market are going away, then eventually they're going to pull their money out in order to get their profits. Billions of dollars are going into the stock market. And if that ends, that means the stock market is losing billions of dollars every month. That means eventually stock prices are going to go down and companies are going to start losing money. So investors, knowing that and knowing when that's pretty much going to happen, are going to slowly start pulling their money from the New York Stock Exchange. This could lead to what's known as a correction, around a 10% drop in the stock market. But that's not all. The Federal Reserve has also talked about raising its benchmark interest rates at least one time in 2022. In order to combat inflation, they're going to have to start raising interest rates. That means people will have less access to money. And when people have less access to money, and the Federal Reserve is printing less, then that means there's less money in circulation, and by default, inflation should go down. If people are spending less money, that means the companies that trade on the stock market are going to see less profits. Investors most likely won't like that, so again, investors might get scared or uncertain of the future, start pulling their money out. And these are all things that the Federal Reserve could and may do that will directly affect the stock market. And it all depends on how much inflation rises over the next month or so. If inflation continues to set new record highs, then the Federal Reserve may have to step in sooner and more aggressively. They may have to raise interest rates even faster or pull back a lot of their bond buying and asset purchasing on Wall Street. If they do this too fast, then that could lead to a stock market collapse. And that means that companies are going to lose money, investors are going to lose money, and the average everyday American is going to lose money. That could have rippling effects throughout our economy. Because remember, a lot of Americans' 401k plans are attached to the stock market. This could delay millions of Americans from retiring. We saw that in March of 2020, and we saw that during the Great Recession as well. But if inflation starts to cool off, then the Federal Reserve will make slower moves. And if they make slower moves, then you won't see a full stock market crash, at least not from what the Federal Reserve is doing. However, most of the inflation that we're feeling right now is due to our supply chain issues. I've talked a lot about this in other videos, but essentially when everything shut down in March and April of 2020, that meant that industries were out of work. they started to get behind, and now they are way too far behind. And it also didn't help that the Federal Reserve was printing and giving people free money, so people were bored and spending more. And now we're in short supply of everything, so that means products are rare. Our economy also works on a supply and demand basis, so if things are in high demand but in short supply, well, then they're going to cost more. And pretty much everything right now is in high demand and in very short supply. And in addition, we have the Great Resignation and labor shortage. That means that companies have fewer people to produce goods. This is all because the Federal Reserve was encouraging people to spend more in 2020. If people weren't spending money, then our economy would have collapsed. But now they're actually doing the opposite. They're changing their monetary policy so that people start spending less and hopefully inflation goes back down. Now, eventually these supply chain issues will work themselves out. Eventually, demand and supply for just about everything will reach an equilibrium. There is an equal amount of products as there is an equal amount of buyers. Honestly, nobody's really sure when that is going to happen, but eventually it will happen. People only have so much money and companies only have so many products. So eventually more products will exist or more people will start making more money and eventually things will even out. However, this does not address all of the money that the Federal Reserve and the federal government has decided to print over the last 2 years. Around 25% of all of the US dollars that are currently in existence were printed over the last 2 years. We had $3 to $5 trillion just in stimulus from the United States government. In addition, President Joe Biden and his administration have just passed the infrastructure bill, and that's around $1.2 trillion just in itself. And now they're moving on to their social spending bill, which is going to cost the country around $2 trillion. In order to fund these programs, the United States government is going to have to print more money. And when the money supply increases, inflation is naturally going to go up. Now, we haven't quite felt the full effects of all this money printing yet, but experts are saying that we will in 2022 and in 2023. So that could mean that the Federal Reserve is either going to have to step in a lot quicker and make some monetary changes, or they might have to pull back and then come back depending on how inflation is going. That means that Wall Street and the New York Stock Exchange is in for a wild 2022. Right now, inflation has hit new record highs. Nobody really knows how long that's going to continue for, and nobody really knows exactly what the Federal Reserve is going to do or what the stock market is going to do in 2022. Right now, the Federal Reserve is in a super tough position. On one hand, they cannot let our US economy and Wall Street fail. But on the other hand, they can't continue to let inflation get out of hand. If they do, this could lead to what's known as hyperinflation. And hyperinflation could mean the death of the US dollar. This is because the currency is becoming so devalued that it basically has no value at all. And that could have some rippling effects in not just the US economy, but the worldwide economy as we know it. The US dollar is the world's reserve currency. That means governments around the world hold it because the hope is that it will always have inherent value. People will always want it. If the US dollar goes down, then a lot of these countries are also going to fall with it. And ultimately, investors on Wall Street want to keep their money protected. So it's in their best interest to watch out for the Federal Reserve, and if they have any problems, they'll pull out their money. And if the Federal Reserve is going to make changes that ultimately affect how much money investors are going to make, then they are going to exit that system and get their profits. It's in an investor's best interest to protect themselves. They don't really care what's going on in the economy. They want to make money at the end of the day. But like I said, nothing lasts forever. So it looks like there might be some major changes coming to the stock market in 2022. And it all depends on what goes down with inflation and the Federal Reserve. So you better buckle up, money minds, because it looks like things are going to get pretty crazy in the business and financial world for the foreseeable future. But now I want to hear from you on this issue. Do you think that inflation will affect the stock market so much in 2022 that we will see a full-on stock market crash? Or do you think inflation will be manageable in 2022 and just transitory like the Federal Reserve thinks it is? In addition, how do you think the Federal Reserve will respond to inflation in 2022? Do you think they will respond faster if inflation continues to rise? Or do you think they will just continue slowly to keep Wall Street and our economy happy? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you like this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.